Record quarterly revenue of $3.966 billion. That is a 24% sequential increase.
Right. And GAAP net income came in at 1.53 per share. But if you look at adjusted EPS, it was way up at 2.12 per share.
And adjusted EBITDA hit $901 million. That's a massive 51% sequential jump.
But on the guidance side, full year 2026 alumina production guidance was actually pulled down by 0.2 to 0.3 million dry metric tons.
Yeah, now landing at 9.5 to 9.6 million. Alumina production and shipment guidance, though, totally unchanged.
Unchanged, exactly.
So if you're allocating capital in the heavy material space or just, trying to make sense of Alcoa's Q2 2026 earnings report, our mission for this deep dive is to sort of tear apart these numbers. We need to figure out what is actually happening beneath that giant top-line revenue beat.
Because there is a lot happening under the hood.
Totally. Based on the earnings release, the management commentary, and the segment data, we're basically looking at a highly complex cash-generating machine that is, on one hand, aggressively trying to consolidate its market position. But on the other hand, they are fighting off some really brutal physical supply chain headwinds.
Yeah. The divergence in this quarter's data is just staggering when you look at the segment breakdowns. I mean, a 24% revenue bump suggests a company that's firing on all cylinders.
Right. You'd think everything is perfect.
Exactly. But the reality buried in the financials is that CEO William S. Oplinger is managing two completely different realities right now. You basically have one segment of the business that is practically printing money.
Subsidizing the other one.
Yes, completely subsidizing another segment that is, frankly, taking on water fast.
Well, let's bypass the top line and go straight into that segment performance.
Yeah.
Because if you're modeling this company's future cash flows, you absolutely have to understand this dichotomy.
It's fundamental.
It is fundamentally a tale of two commodities. So I want to start with the aluminum segment, which is undeniably the star of the show this quarter.
Oh, without a doubt.
Production ticked up 5% sequentially. To 636,000 metric tons. But the number that really jumps off the page is the shipments.
The 18% surge?
Yes, an 18% surge in a single quarter for a heavy industrial producer. That is massive.
It's huge.
When I first saw that, I naturally assumed, oh, that must be a sudden spike in end market demand. But the sources actually point to something much harder to pull off. It's about execution on capacity restarts.
Right. That 18% volume increase is really a brute force operational win. They successfully brought dormant capacity back online across multiple geographies.
We're talking about this San Ciprián smelter in Spain, right?
Spain, yes, and the Lista facility in Norway, plus the Portland operations down in Australia.
And some progress in Brazil, too, I think.
Right. Continued progress at Alumar in Brazil. And for anyone modeling these heavy industries, you know that restarting a halted aluminum smelter is, well, it's arguably one of the most high-stakes, delicate engineering feats in the whole sector.
Because of the equipment involved.
Exactly. You are dealing with massive pot lines. If you bring them back online too fast or, if the energy mix isn't perfectly calibrated, you risk catastrophic failure to the equipment.
Oh, wow.
So executing these restarts across 3 different continents simultaneously and actually translating that into shipped volume, that signals a very tight grip on operational discipline.
It's worth noting, they also caught a bit of a tailwind from inventory repositioning in North America during the first quarter.
Right, true.
Which they were finally able to monetize in Q2.
Yeah.
But here is the mechanism that really supercharged this quarter. It wasn't just that they shipped 18% more volume. It was the leverage they got on the pricing side.
The pricing was incredible.
The realized third-party prices for their aluminum basically went vertical. They jumped from $4,209 per metric ton in the first quarter all the way up to $4,752 per metric ton in Q2.
Which, that creates a beautiful scenario for any heavy manufacturer. When you combine an 18% volume surge with, roughly a 13% jump in realized prices?
Yeah, about 13%.
The leverage to the bottom line there becomes explosive. Because the fixed costs of running these massive smelters, the baseload of electricity, the labor, the facility maintenance, those are already baked in.
Right, you're paying that anyway.
Exactly. Once you clear that break-even threshold, basically every additional dollar in realized price falls almost entirely to the bottom line.
It's pure profit at that point.
Yes. And that operating leverage is the exact mechanism that drove the aluminum segment to post a staggering segment adjusted EBITDA of $1.073 billion.
So that is the engine running hot. But if we are flying a twin-engine cargo plane through a storm right now, we have to talk about the other engine.
The sputtering one.
Yeah, the alumina segment. This is the raw material segment. So you mine the bauxite, You refine it into alumina, and then you smelt it into aluminum. And the middle step of that supply chain just had an abysmal quarter.
Truly abysmal.
Aluminum production dropped 6% sequentially, down to 2.2 million metric tons.
Yeah, and the drivers dragging down that alumina segment are essentially a textbook case of compounding operational and environmental failures.
It wasn't just one thing.
No, the core issue traces back to severe instability at their Pinjarra refinery in Australia, which actually started late in the first quarter. But the situation went from bad to critical when Cyclone Narelle hit.
Right, the weather event.
That extreme weather event caused major disruptions to the natural gas supply feeding the facility.
And if you understand the chemistry and physics of refining alumina, you know that gas supply isn't just like an operational preference.
No, not at all.
It is the absolute lifeblood of the process. You are essentially cooking bauxite. It requires immense, continuous amounts of heat and energy to trigger the chemical reactions to extract the alumina.
Right, and without a stable high-pressure gas supply, that thermal process just breaks down completely.
It just stops.
Yeah, the refinery either grinds to a halt or operates at such severe inefficiencies that you're basically burning cash just to keep the lights on.
Which we saw in the financials.
Exactly. That disruption rippled violently through their numbers. Third-party revenue for the alumina segment decreased by 3%, which, okay, doesn't sound catastrophic on the surface.
But the margins.
The margins were the real hemorrhage. The segment posted an adjusted EBITDA loss of $96 million.
Wow.
That is a sharp deterioration from the $40 million loss they recorded in Q1.
So the alumina engine is sputtering, taking on extreme weather, supply chain snags, gas disruptions. Meanwhile, the aluminum engine is running so hot on those soaring realized prices that it is literally carrying the entire company.
Carrying the balance sheet, all the cargo, to a record altitude.
But if you're looking at this from a risk management perspective, you really have to ask, is this level of price dependency in the aluminum segment a fundamental vulnerability?
Because it's cyclical.
Right. Because if those realized prices of $4,752 a ton start to cool off, this whole plane loses altitude incredibly fast.
Well, being a price taker on the global commodity market is the inherent vulnerability of the entire business model. Management knows they cannot dictate global aluminum prices.
They're at the mercy of the market.
Yes. But the defense strategy here isn't to fight the market, it's to exploit the volatility. When the cycle swings wildly in your favor, as it is doing right now, you generate outsized, almost aggressive levels of cash flow.
Right.
The strategic imperative then becomes how fast and how effectively can you deploy that boom cycle cash to permanently alter your cost curve? How do you widen your defensive moat for the inevitable downturn?
Which brings us directly to capital allocation. You look at the cash flow statement, and they generated $608 million in cash from operations this quarter.
That's a lot of cash.
It is. Free cash flow was a very healthy $422 million.
Yep.
And they finished Q2 sitting on a cash balance of $1.4 billion.
A huge war chest.
But if your upstream supply chain, your alumina refineries, is cracking under the pressure of external shocks, hoarding $1.4 billion in cash isn't conservative. It's negligent. You have to buy your way into a more secure position.
And that is the exact pivot they made. The defining strategic move of this quarter, and perhaps of Oppinger's current tenure, is the Alcoa Group acquisition.
The South 32 deal.
Yes, on June 30th, they inked a definitive agreement to acquire South 32's interests in bauxite, alumina, and aluminum assets spread across Australia, Brazil, and South Africa.
Let's just frame the scale of this for a moment. This is a $4.1 billion upfront consideration.
Plus a contingent value, right?
Right, attached for up to another $750 million. So they are dropping roughly $5 billion to fundamentally reshape their footprint.
It is a massive bet on vertical integration. Alcoa is aggressively doubling down on its identity as the world's leading pure-play upstream aluminum company.
So they're taking control of the whole process.
Exactly. By absorbing South 32's assets, they are effectively buying their own supply chain insurance. They take out a major competitor in the raw materials space while simultaneously creating geographical synergies.
Like in Australia.
Right. When you look at where South 32 operates in Australia and Brazil, it perfectly overlaps with Alcoa's existing footprint. The goal is to integrate those bauxite mines and alumina refineries so deeply into Alcoa's system that a failure at one facility like we saw at Pinjarra doesn't cripple the entire segment.
You build redundancy into the system.
Precisely.
So they are making this multi-billion-dollar offensive maneuver, but they are also using the cash from the aluminum boom to execute some highly defensive housekeeping.
A debt reduction.
Yeah, they took cash on hand and completely redeemed the remaining $219 million of their 6.125% senior notes due in 2028.
Which is smart.
If you are assessing capital structure in our current high-rate environment, wiping out 6% debt using operational cash is just a zero-risk, high-reward move.
It permanently lowers their cost of capital moving forward. But if we are talking about defensive maneuvers, we really have to look at the labor agreements they ratified this quarter.
Right, the union deals.
They locked in a 4-year deal with the United Steelworkers for their U.S. smelters in Indiana and New York. They secured a 5-year deal with the USW in Quebec, Canada.
In Australia, too.
Crucially, yes. They ratified a 4-year agreement with the Australian Workers' Union, covering roughly 1,400 employees across their mining and refining operations in Western Australia.
I really want to dig into why labor peace is treated as a critical operational metric in this specific industry, rather than just, an HR talking point.
It's so much more than HR.
We just discussed how sensitive these facilities are to disruptions, like the gas supply issue. The threat of a wildcat strike in an aluminum smelter is literally an existential risk to the physical assets themselves.
Because of the physics of the smelting process, inside those facilities, you have hundreds of reduction pots holding liquid metal at over 1,000 degrees Celsius.
That sounds intense.
It is, and that heat is maintained by a continuous massive electrical current. If workers walk off the job and those pots are not actively managed and properly powered down, the liquid metal literally solidifies inside the pots.
Wait, it just turns solid.
It does. You don't just lose a few days of production. You turn a multi-million-dollar high-tech piece of industrial equipment into a giant, useless block of concrete.
Oh, man.
The cost to chisel that out and rebuild the pot line is astronomical. So, paying up to secure 4 to 5 years of labor peace across North America and Australia, that removes a catastrophic variable from their risk models.
Got it. They're also deploying capital into future-proofing the technology, which is interesting. The sources highlight a $65 million investment at the Machine Cast House in Norway
Right.
to add recycled content capabilities to their foundry production. Additionally, they reached a final investment decision for a gallium production plant, co-located at their Wagerup refinery in Australia, alongside government partners from Japan, the U.S., and Australia.
Well, the Norway investment is just a straight margin play. Global end markets, automotive, aerospace, consumer tech, they are all demanding lower carbon materials.
So they can charge more for it.
Exactly. By integrating recycled aluminum into the casting process, Alcoa lowers the overall carbon footprint of the final product, which lets them command a green premium on the pricing side.
The gallium project is what really caught my eye, though. Gallium is a critical mineral heavily used in semiconductors, advanced electronics, and defense applications.
Very high demand right now.
And the brilliant part is that they aren't sinking a new mine to find it. They are extracting it as a byproduct from the existing alumina refining process. It is a highly efficient way to squeeze high-tech geopolitical value out of a legacy industrial process.
Which transitions perfectly into the geopolitical pressures they are facing. Because as much as management is trying to optimize the things they can control, like labor, debt, acquisitions, they are taking a beating from the macro forces they cannot control.
And this is where we have to confront the gap between the GAAP earnings and the adjusted
The
earnings.
gap is huge.
It is massive, and it's where the real story of the quarter's headwinds is hiding. They reported GAAP EPS of $1.53, but adjusted EPS of $2.12. To bridge that gap, management backed out $155 million in what they classify as net special items. The lion's share of that was a $123 million mark-to-market loss on their shares in the Saudi Arabian mining company, Ma'aden.
For anyone analyzing the cash flow, this is just one of those frustrating accounting quirks. They didn't sell the Ma'aden shares and realize a $123 million cash loss.
The stock just went down.
The stock price simply dropped during the quarter, and accounting rules force them to record that paper loss on the income statement. It's a not-operating hit. It distorts the actual operational cash the business generated, which is exactly why management excludes it from the investor numbers.
Right. And I have no issue backing out paper losses on stock holdings. That makes sense. But the other major special item was a $45 million mark-to-market loss on energy contracts.
Yes, the energy hit.
And when you read the management commentary, they specifically call out higher fuel oil and diesel prices driven by the ongoing conflict in the Middle East. They also point to lower third-party energy sales and increased tariff costs on imported aluminum, explicitly citing Section 232 tariffs on metal moving into the U.S.
This is the reality of operating a global physical footprint.
Mm-hmm.
Your exposure to geopolitical trade policy and global energy markets is total. A flare-up in the Middle East immediately spikes diesel prices, which immediately increases the cost of running the massive dump trucks hauling bauxite out of the mines in Australia.
Everything is connected.
It is. And Section 232 tariffs act as a direct tax on their ability to optimize where they smelt the metal versus where they sell the metal.
Here's where I have to push back on management's framing, though. Corporate teams love to take the impacts of extreme weather, energy volatility, and tariffs and dump them into this bucket of special items to arrive at a cleaner, adjusted EPS.
To make the numbers look better.
Exactly. The logic is that these are one-off anomalies. But look at the landscape we just walked through. We have cyclones taking out natural gas pipelines in Australia. We have Middle East conflicts permanently altering the floor price of diesel.
The tariffs, too.
We have entrenched multi-year trade wars keeping tariffs elevated. If you are building a model for heavy industry in the late 2020s, I would argue these are no longer anomalies. This extreme volatility is simply the new permanent cost of doing business.
That is the exact debate ripping through the analyst community right now.
Is it?
Oh, absolutely. If a company's alumina assets are located in a region increasingly prone to severe weather, at what point does the cyclone cease being a special item and become a predictable, modeled cost of goods sold?
Right. You have to bake it in.
Management teams adjust these costs out to present the core earning power of the business under normalized conditions. But if the global environment is undergoing structural changes where normalization is a myth, relying entirely on adjusted EPS gives you a false sense of security.
It masks the actual risk.
It masks the true cash-generating resilience of the company in a very chaotic world.
The GAAP numbers tell you the painful truth of what actually hit the bank account. The adjusted numbers tell you what management wishes had happened in a frictionless vacuum.
That's a good way to put it.
But let's look forward, because management provided specific guidance for the third quarter. Are they modeling for the friction to ease up at all?
In the short term, they are forecasting marginal relief. On the struggling alumina side, they expect a sequential favorable net impact of roughly $10 million.
Okay, so a slight bump.
They are modeling this based on the assumption that the Pinjarra refinery will stabilize now that the cyclone disruptions are behind them, coupled with an expectation of lower global energy prices. However, they were careful to note that this $10 million benefit will be eaten into by planned maintenance downtime.
Where is that happening?
At the Alumar refinery and the Juruti mine down in Brazil.
Okay, what about the aluminum segment? Does the Star engine keep pulling the weight?
Management expects the sequential favorable impacts to continue there, driven heavily by efficiencies at higher production rates.
So economy of scale, basically.
Exactly. As those smelters in Spain and Australia reach their optimal, steady-state run rates, the cost per ton drops. They project these efficiencies will be strong enough to fully offset rising carbon prices in Europe and seasonally lower energy sales in Brazil.
What about the tariffs?
Based on current pricing models and an expectation of lower shipment volumes crossing the border from Canada, they project that the Section 232 tariff costs will actually decrease by about $10 million sequentially.
Okay, good to know.
And finally, if you're modeling the tax line, they expect third quarter operational tax expenses to land between $80 and $90 million, highly dependent on which jurisdictions generate the most profit.
So bringing this all the way back to our twin-engine plane flying through the storm, what we are witnessing is Alcoa aggressively doubling down on physical upstream assets. They are committing billions to the South 32 acquisition to become the undisputed heavyweight in bauxite and alumina.
Going all in on the supply chain.
Right. And they are doing this exactly at a time when global supply chains are proving incredibly fragile against extreme weather and geopolitical shocks.
It's a huge gamble.
It really is. It leaves you with a critical question to consider as you analyze this sector. In the coming decade, will owning and operating the raw upstream physical assets prove to be the ultimate defensive moat that guarantees supply? Or will it become a massive, unmanageable liability exposed to every global shockwave?
That is the big question.
Join us next time for another deep dive and follow the show for daily earnings coverage.